Hey everybody, I hope everyone is doing well and had a good day. In today's video, we're going to review the E-mini S&P 500 5-minute chart for Thursday, August 6th, 2026. On the daily chart, we have this strong bull breakout above a trading range to the left. You can call it a bull flag, bull trend, trading range, maybe a double bottom, bull flag, and then strong trend resumption here. And we have, yesterday we had a bear trend bar on the daily chart. The bar itself is a strong signal bar, but the context is not great for selling. After such a strong rally, the odds are the first reversal will fail to reverse the trend. We'll probably find buyers below, and the bulls are likely to get a second leg up. The problem for the bulls is that it was a pretty decent bar on daily chart, bear trend bar closing near its low. So it's possible that this bar on the daily chart gets a small second leg down. I also have the high of the trading range to the left here drawn. It's a breakout point. So if you think about it, when the market was in the trading range here, traders selling at resistance are making money. We test resistance again. Traders sell, they make money. They sell near resistance, they make money. But the traders selling at resistance here, the market breaks out above the trading range, far above the trading range. The traders selling here get trapped, and that creates support. So it's possible that the market pulls back to the breakout point, but the odds are there will be buyers here because of the trapped traders. So buyers at Tuesday's low, which is close to the top of the trading range, the breakout point. So for today, I'm not expecting strong selling below yesterday's low, but also maybe not aggressive buying below the bar. It's a strong enough bar that we may get a small second leg down. 5-minute chart, we had a small gap down going into the day. Bar 78 yesterday was a strong enough bear bar to expect a second leg down, but then we had a 3-bar micro channel, a deep pullback after it, and that's the traders who sold 78 are disappointed by that reversal, and that increases the probability that traders will buy at the close of 78 and at yesterday's low. So probably buyers here. I talked about that on the daily chart. Bar 1 attempting to break out below yesterday's low, but then failing to close below. We have a trading range bar. There's probably buyers below 1 and probably sellers above 1. At 2, a bear reversal bar. Bar 2, it's an okay sell signal bar, but the body is fairly small. It's more of a trading range bar. If you're selling bar 2, you're selling at support. The market tried to break out 78, reversed up strongly, tried to break out below on bar 1, reversed up all the way to the high of bar 2. So selling here, not ideal. There might be more buyers below bar 2. It looks like a limit order market, trading range on the open. 3, outside up, bull breakout. So we triggered the sell below 2, trapping traders below bar 2, and then reversed up on 3. I said limit order market, there's probably sellers above 2, sellers above 3. And then same with trap traders here. Anybody in theory buying bar 81 gets trapped by the gap down into the day and the bear breakout. And that creates resistance, which contributes to the likelihood that there's sellers above bar 1. And we're testing there again on bar 3, probably sellers here. But then bar 4 broke out above the resistance, broke above the moving average, the bars to the left, the close of 81. That's good for the bulls. So traders selling here are trapped by the bull breakout. Now the bulls have a breakout and follow through. They'll probably get a second leg up. Bar 4 is a weak stop order sell, probably buyers below the bar. The problem with buying up here, look to the left, breakout point created by the bar 78 breakout. So we might pull back here, but I said 3 and 4, strong enough breakout follow through. It'll probably get a second leg. So expect a pullback. We might bounce at resistance, but still expecting a second leg up. Bar 5, it's a micro channel. Is bar 5 going to reverse 3 and 4? Strong pair of bull bars compared to bar 5? Probably not. Bar 5, more likely buyers below the bar. We find buyers below the bar, failed breakout below, going sideways for 3 or 4 bars here. 6, and 7 going sideways. Trading range, probably sellers above bar 5. Resistance to the left, just looking at yesterday's chart. Trading range, the market went sideways for a lot of bars here. And then we got the big breakout on 78. So anybody trading in here, buying through here, buying at support, trapped by the bear breakout 78, that creates resistance in this area. So expect sellers up here. 6, 7, and 8, 3-bar micro channel, bulls getting possibly trend resumption, a second leg up. But looking to the left, it looks like it's a trading range. And if you look at just the bars since 78, we went down, we went up, we went down, we went up. So it looks like we're still in a trading range. So as far as buying here, it's not ideal, but we do have a 3-bar micro channel. There might be more buyers below 8 for a second leg. 9, 4-bar micro channel, probably buyers below 9. Enough momentum to expect a second leg, but possibly leg 3 near resistance. So not ideal for buying. If you're buying, you're probably scalping, taking quick profits, betting that the first reversal will fail, but also the upside is probably limited. Outside up 10, now it's a nested wedge, different ways. Different computers will draw the wedge in different ways. Through here, it's a wedge, maybe 7, pull back 8 or 9, pull back 10. I had this one drawn here, 81, 4, and 10. So different ways to draw bull channel lines. It's basically a high one buy, but at the top of a trading range, there's probably sellers above bar 11 or bar 10. 11, bear reversal bar closing on its low. Strong enough bar that bulls will probably exit below it. The risk is that we're at the top of a trading range, and now we have a strong bear bar, and the market can pull back somewhere toward the middle of the range. We can quickly come back here in this area. Is it a perfect trade? No. It's a tight bull channel, so maybe better for the bears to get a second entry short. Technically, you can call it a second entry short. We triggered the sell below 9, outside up on 10, and then a second entry short below 11. So reasonable stop order sell below 11. 12, a big bear breakout bar, which is good for the bears who sold, but now they're probably taking profits as we quickly approach the middle of the trading range, likely to pull back, but decent pair of bear bars, 11 and 12, it'll probably get a second leg down. Pulling back 13, breakout point above bar 10 low, moving average, probably sellers above, and you can see the market testing the moving average and getting a second leg down. We didn't quite get to that breakout point, but we did test the moving average, and clearly 11 and 12 getting a second leg down here, 14. Probably going at least a little bit lower, but we do have yesterday's low acting as support. So we'll see, can the bears break below it, or will buyers come in again? 15, market bouncing. It's a tight bear channel. Better to wait for a second entry long here. For the bears, leg 1, pull back, leg 2, pull back. So if you're selling here, you're probably selling leg 3 near support. Not ideal. Probably buyers below 15. And 16, probably buyers below as well. Like I said, leg 3 at support. Then 17, a bull, outside up bull breakout bar. That's good for the bulls. 3 legs down to support. It's kind of the opposite of 3 legs up to resistance on bar 11. Traders, bears probably exit shorts above 17. Bulls can buy for a scalp. The problem with buying here is this is a tight bear channel. And a tight channel is a breakout on a higher time frame. So bear breakout, expect a pullback, which we're getting here on 17, but ultimately expect a second leg down. And the traders who bought up here, like I drew this breakout point below 10, anybody buying below bar 10 gets trapped by the bear breakout on 12, and then it gets more follow through. So anybody long up here is trapped and disappointed by the sell-off. And that might limit the upside. But strong enough bar 17, it'll probably get a second leg. 18, bulls get a strong follow-through bar, although it is smaller than bar 17. And then it's testing that resistance. So we'll see, can the bulls get above the breakout point, or are the bulls who bought here trapped, disappointed, and will they use 18 or 19 to exit at break even on their original entry? And then if they bought more lower, they can exit with a profit on their lower entries. Good pair of bull bars 17, 18, second leg up likely, probably buyers below 18. But it's confusing. Big down, big up. The tight bear channel down to 16. We'll probably get a second leg down, but now the bear breakout follow through 17, 18 looks like it's strong enough for a second leg up. Outside down on bar 19, so selling off, reversing down at resistance. Strong enough bar, it does damage to bars 17 and 18. Bar 17 reached a measured move. I should draw it this way. A leg 1 equals leg 2. Measured move reached on bar 19. Also testing that breakout point. It's possible 19 is resumption down. Tight channel, leg 1, deep pullback, and then maybe leg 2. The bulls are hoping it's a breakout pullback, buyers below 18, and that they'll get a second leg, and will probably hesitate at least, but 19 is a strong enough bar that it may get a second leg down of its own, and that's going to damage the bull case. Anybody who bought on 18 is now trapped by 19, so there's probably sellers above. Inside bar 20, but probably sellers above. Like I said, anybody who bought 18 is trapped by 19, disappointed. That creates resistance above the bar. 3-bar micro channel to 21. It'll probably go at least a little bit lower, test the close of bar 16, maybe the low of 17, maybe even the bar 1 low. Bar 1, the probability that bar 1 remains the high or the low of the day is about 20% on any day. This looks like a trading range day. The odds that bar 1 remains the low of the day, like I said, is about 20%. So that's a magnet the bears are likely going to get here. You can see tight channel to 16, bear breakout, deep pullback, leg 1 equals leg 2 measured move. Just about gets you there. So the bears have a target in mind. Selling 21 is okay. You're selling bearish momentum. You're selling near support. So let's see, can the bears break below support? 22, bear breakout bar, which is good for the bears, but it's a bigger bar and there's a bear channel line. Also the bar 1 low, so we're testing the leg 1 equals leg 2, profit target, the bar 1 low, profit target. It is a trading range, so we might find buyers below 1. Bears have 3 legs down with the channel line. So we might bounce here, but because of the 4-bar micro channel, an immediate reversal is unlikely. This sell-off down to 22 will probably get a second leg down. And then look at bar 23. Is 23 going to reverse sell-off? It's very unlikely. It's a bad stop order buy, so a low probability stop order buy is a high probability limit order sell. The problem for the bears is risk reward. The stop is up here, so they can sell, but the risk is huge. But the probability is we're going at least a little bit lower, and the bears will get a second leg down. Bull breakout 24, but lots of overlap with the prior bar. Once again, is 24 strong enough to reverse the sell-off? Probably not. A beginner might see 3 legs down to support, and then a pretty decent buy signal bar, and I think that's a reasonable buy. Small risk, big reward. Maybe you make 3 or 4 times your risk on the trade. But whenever you have great risk reward, you know you have low probability. Probably sellers above 23 and 24. Second leg down, likely. Outside down 25. But once again, near the channel line, the downside might be limited. So we're hesitating. Bears are selling pullbacks instead of selling below bars here. 27, the tight channel for the bears continuing. Probably only want to be selling here. But 27 forcing you to sell far below the moving average. And it's clearly near the channel line, which is not ideal for selling. We're at support, so we might bounce here. 28, we're bouncing. We're getting a minor reversal. As big as 28 is, it's still more likely a minor reversal. Big sell-off relative to the bar on 28. Also, look where 28 is testing. Breakout point, yesterday's low. Yesterday's low was support. So we sold off here, rallied, sold off, rallied, sold off, rallied. So clearly this is acting as support. Every time the market gets to support, it bounces, it reverses up and rallies. But then we broke below on 22. So anybody buying at support, they did something reasonable, but they got trapped by the bear breakout 22. So support becomes resistance. So we're testing there on 28. Big breakout bar, but against a tight channel, testing a breakout point. First break of the bear trend line as well. So more likely we're going to test the lows before there's any major reversal. Outside down on 29, huge bar. So big bar means big risk. Nested wedge, we talked about this one. 1, 2, 3. Smaller picture here. 1, 2, 3 legs down. So big bar in a nested wedge far below the EMA. 29 not ideal for selling. Bears might sell a pullback, but we're going sideways here since bar 23. This looks like a trading range. You can call it an expanding triangle, higher highs and lower lows. Either way, breakouts are failing. We try to break above, we fail, reverse down. Try to break below, we fail, reverse back up. Try to break to the upside, reverse down. Try to break to the downside, probably going to reverse up. And bears failing to get follow through. If you're selling a big bar far below the EMA in a late leg, like bar 29, you do not want to see bar 30 as your entry bar. So bears might give up here and look to sell higher, and bulls are gaining confidence that they can buy value far below the EMA in a trading range. But a bad stop order buy 30 and 31, so probably sellers above for a second leg down. We trigger the buy, we find sellers above 33, but continuing to go more sideways here, probably buyers not far below 31. And then a second reversal 34, bull bar closing on its high. Strong enough bar and good enough context that bears probably exit shorts above 34 and bulls can buy. Doji bar, so continuing to go sideways here in a trading range far below the moving average. 37, so 34, anybody buying 34, they were able to capture a second leg up. We find resistance at the EMA. It is a micro channel, 34 through 37. There might be buyers below 37. It's not a great stop order sell below the bar. It's a trading range through here, so there's probably buyers below 37 scaling in lower. The micro channel isn't very strong. It's made up of 3 or 4 doji bars, but we do have trending lows and trending highs, so there's probably enough momentum that the first reversal down will fail, and there's buyers below 37. Instead of triggering below the bar, we get a bull bar 38, but 38, it's a great looking bull bar. It's a bull trend bar closing on its high. On the lower time frame, it's 3 legs up, 34, pullback, maybe 37, pullback, 38. It's testing the moving average resistance. So not a good location for buying here, but strong enough micro channel that the first reversal down will probably fail. So everything I said about 37 applies to 38, but now the bull case is stronger with the bull bar closing on its high. Probably buyers below 38, and this will probably get a second leg up. 39, strong enough bear bar that you can expect a second leg down. For the bears, they have the bear channel, the bear trend line, reversing down at the trend line. That's good for the bears. But because we've gone sideways here for a lot of bars, we might be testing near support. And the momentum up to 38 is strong enough that there's probably buyers below 38 looking for a second leg up. instead of selling 39, maybe traders will sell a pullback. Why sell a pullback? For the reasons I said. We're testing near support, and the bulls have enough momentum that they're probably buying the first pullback, looking for a second leg. But then there's probably sellers up here because 39 objectively is a strong bar. It's a strong bear breakout bar. Price moved a big distance from the close of the prior bar to the close, from the close of 38 to the close of 39. So anybody who bought 38, they're disappointed with their entry bar. Just imagine if you bought bar 38 and 39 is your entry bar. You were never holding a profitable position during that trade, and you have a terrible entry bar. So what are you going to do if the market gets back to your original entry price? Probably going to sell. Bad entry bar for the bears, 39, bar 40, bull bar closing on its high. I said micro channel, probably buyers below, bulls looking for a second leg up, but 39, strong enough bar that there's probably sellers above. So maybe buying 40 is okay for a scalp, but the upside's probably limited. And 39 strong enough, we may hesitate first. 41, probably buyers below and sellers above. 42, it's a 3-bar micro channel. We're testing resistance. The traders back here on 28. Anybody who bought here, trapped by 29, that's resistance. The traders who bought 38, disappointed, that's resistance. 3 legs up, 33, 38, and 42. Bull channel line. So you have the bull channel line resistance. You have the close of 38, close of 28. All of this is a resistance area. So 42, great looking bar, but bad context for buying. Probably sellers above. 43, bear reversal bar closing near its low. Good sell signal. Context is good. 3 legs up to resistance. Not a perfect trade. 40 through 42. It's a micro channel, so the first reversal might fail, and the bears might prefer a second entry short. But if anything here, bulls are probably exiting longs below 43, and bears can sell and scale in higher. And then a bear breakout 44. Reasonable sell, probably going at least a little bit lower. Bears will probably get a second leg down. But because of the rally 40 through 42, any bear who sold 38 got trapped by the reversal up, and that creates support. So probably going to bounce in this area. If not there, there's a layer of support. Just look to the left. Every time the market tries to break out down here, it's reversing up. But strong enough bar 44, expect a second leg down. Market's in a trading range, so buy low and sell high. Micro channel, expect sellers above and a second leg down. We're bouncing at support, but was 46 strong enough to reverse the micro channel? Probably not. More likely sellers above, but we did not trigger above the bar. Micro channel continues. Smaller structure, spike, pullback, and channel on the lower time frame. Probably buyers below 47. Buyers below 48. It's a channel in a late leg near support in a trading range. And you maybe can look at a lower time frame chart and see that more clearly. Spike and channel, 3 legs down to support, which is why there's probably more buyers below 48. Bears are taking profits and bulls are buying. What about buying 49? The context is reasonable for buying, but it's not ideal because it is a micro channel. We're testing the trend line. Second entry long would be better. So there might be more sellers above 49, although 49 not great for selling above. Bears prefer to sell above bear bars, not bull bars closing above their midpoint. So the sellers might come in above 48 instead. Micro channel, bears looking for a second leg down. But look at the context. Market's in a trading range. And I said, or, Al says, it's a trading range, buy low, sell high, and scalp. So where are we in trading range? We're closer to support. We're closer to the bottom of the range. It's a low one short on bar 50, bear micro channel, pullback, low one short. But a low one at the bottom of a trading range is a buy setup. There's probably more buyers below bar 50. Strong enough micro channel, we may go a little bit lower. Buyers may not come in until below 49 or maybe 34. down here. But in this context, there's probably more buyers below the bar. And then the bulls get a second entry long 51. That's a reasonable buy. Context, the problem with buying 49, it was the first reversal. Better to wait for a second entry long. So bear trend line, we broke the trend line, we got a test of the lows, and then traders buy near support. Second entry long, bull reversal bar closing on its high 51. Bulls will buy that. Bears will exit above it, and bulls will buy to go long. Second entry long, bottom of a trading range. It's a reasonable stop order buy. 52, bear reversal bar. So bad entry bar for the bulls buying, but think about what I just said. For the bears, bar 50, low 1, bar 52, low 2. Bear breakout, low 1, low 2, but a low 2 at the bottom of a trading range is a buy setup. Probably more buyers below 52. Outside up 53, bull breakout, strong enough bar, probably going to get a second leg up. We're testing close to a breakout point, but there's room to it, probably going at least a little bit higher. And maybe we'll test the top of the range. 54, breakout, follow through, good for the bulls. We'll probably get a second leg up. 3-bar micro channel, but approaching resistance, so we may bounce here, but the momentum is strong enough that the first reversal down will probably fail, so expect buyers below 55 and a second leg up. Expect buyers below 56, buyers below 57. The micro channel continuing to grow, testing resistance. So we're back at the top of the trading range, but there's really no selling pressure, not a lot of selling pressure through here. So the first attempt at reversing this micro channel will probably fail and become a pullback and lead to a second leg up. So expect buyers below 57. Bad stop order sell. Outside up 58, so the buyers come in below 57. The bulls get resumption, but a trading range bar 58. Expect sellers above and buyers below. Inside the bar going sideways, still expecting sellers above and buyers below. Now we have a 4-bar micro channel, not especially strong. Big trading range bar, bull bar, trading range bar, and then a breakout bar 61. But anybody buying up here is trapped by the bear breakout, and that creates resistance above. You can see the market's behavior as we test yesterday's low once again. I should have drawn the wedge also. We had the channel from back here. There's a bull channel line, and we're testing it once again on bar 58. But also colliding with yesterday's low, which became resistance, and it's behaving like resistance. The market gets there, it sells off, tries to break out, reverses down. The rally is still strong. It's a tight bull channel from 51 or 49 to 59. So expect a second leg up, but the sell-off down here to 61 disappoints the traders above. So expect a second leg up, but also expect sellers above with disappointed bulls up here, limiting the upside. Micro channel continuing, good for the bears, probably sellers above 62. 63, weak stop order buy, expect sellers above the bar, expect the micro channel to get a second leg down, but it's confusing again. We have a bull breakout strong enough for a second leg up, bear breakout strong enough for a second leg down. So what happens here? Well, we're testing support. I talked about bar 58. It's a trading range bar, so expect buyers below, sellers above. We get below the bar, expect buyers. Also strong enough momentum, expect a second leg up. We're channeling down, big tail 60, overlapping bars here, big tail 63. Might be 3 legs down on the lower time frame to support. But it is a micro channel, and price moved a big distance from up here. So anybody buying up here is trapped by the reversal down, and they're disappointed, and they're probably selling up here. But anybody selling down here, I talked about 57 being a low probability sell. Traders selling here get trapped, and that creates support. which we're testing here. So you can expect a reversal, a failed bear breakout and a reversal back up. Strong momentum, expect a second leg up. Trendline break, good for the bears, but we're probably going to test the highs. I said micro channel, bad stop order by 63, so probably sellers above. But the context, the sellers may not come in until near the top of the range, so selling here may not be ideal. And then 64 is a bad sell, so probably buy the close, buy below the bar. And then going sideways for 3-4 bars, expect buyers below. And the sellers, once again, the sellers may not come in until we're closer to resistance. The bulls are expected to get a second leg up after this rally. And the bears, yes, expect a second leg down, but the pullback can be deep. Bears might not want to sell down here at support. They might want to wait to sell at resistance. 67, strong bull breakout bar. It's basically a perfect breakout bar, no tails, so it's closing on its high. It's a big body. The signal bar, or the bar itself, is great. It's a very strong bull bar, but the context, look to the left and think about what I've been saying. We're testing resistance. Yesterday's low, once again. Just imagine if you bought here, bought anywhere up here, if you bought the close 59 or bought below 59, and this is the follow through you get, you're disappointed. It's okay to buy here if you use a wide stop and you're willing to scale in, because when you get a pullback, you can scale in at support, scale in, at locations that make sense to scale in, like the moving average below 58, maybe above a bull bar, second entry long. And then you get 67. What are you going to do if the market pulled back like that? If you bought up here, you bought here, you're holding a losing position, you scale in lower, and then 67 gives you an opportunity to exit at break even on your first entry and with a profit on your lower entry. So the context is not great for buying here. You have disappointed bulls who got trapped by the reversal looking to sell. The bull channel line comes into play again as well, probably limited upside. Bulls get a follow through bar 68, but much smaller bar and not even breaking out above 58. So it's not really breaking out above this range yet. So can the bulls break out? And we were expecting a second leg up. After this tight channel, we got a pullback. And guess what? The bulls got their second leg, and now we're back at resistance. The trendline break disappointed the traders up here. I said a second leg down was likely, or I should have said a second leg sideways to down is likely. Trendline break, retest of the highs, expect sellers up here, and then for the bears to get a second leg down. 69, strong bear reversal bar, good context. Near the bull channel line, it's a double top. Basically, it's a bull trend line break, retest of the highs, and then a strong bear bar. Bulls will exit below that bar, and bears can sell. Is it a perfect trade? No. You have a bull micro channel. Second entry short would be better, but bulls probably exit below 69, and bears can sell and scale in higher. The risk is that the micro channel here gets a second leg up of its own. Reversal follow through, bar 70, a bad stop order buy. Expect sellers above, expect the bears to get a second leg down. Outside down, now it's a tight bear channel, 69 through 71. Expect lower prices, but we might bounce at support here. So we're finding a trading range bar 72 near support, but tight bear channel, probably sellers above 72. 73, a strong bull bar, not great for selling above. Bears would probably exit above that bar. It's a double bottom at support in a trading range. And 73 is a strong signal bar. So bears can exit above that bar and bulls can buy. Although it's not ideal, it's a tight channel. It'll probably get a second leg down. 74 did not trigger the buy above 73. So even if bears put a stop order to exit shorts above 73, they could still be in the trade. And what about the downside here? It looks like a trading range here. If we do break lower, there's support to the left. These lows here, maybe this low are 53. Tight channel continuing, 3 legs down to 75, approaching support, probably buyers below 75. As far as buying 75, not ideal. Tight channel, bad signal bar, expect more sellers above 75. Then 76 is a reversal bar. Still not likely to reverse the tight channel, but it is occurring in an overall trading range and now closer to support. Think about the bars to the left. Remember the low 2 I talked about, bar 52. Bear breakout, low 1, low 2. Some bear sold below 52, looking for a second leg down. Breakout, pullback, looking for a second leg down here. But instead, they sold and they got trapped by the rally. That's why I drew support here, that's why I drew a horizontal line here. I'm expecting support because of the trap on bar 53 and then the rally. Anybody selling below 52 gets trapped, disappointed, and that creates support, or at least the expectation is support. And we're bouncing here at that support. 3 legs down to support. 76 not especially strong for buying, but bears probably exit above the bar. Second entry long would be better for the bulls. We try to break below support again and then go outside up 77. So what about buying 77? Overall, pretty much in the middle of the trading range, so it's really not ideal for entering here. Better to buy below the bar and then sell closer to resistance. Market pulls back, so bulls, rather than buying the close of bar 77, the market pulls back, and then maybe they buy closer to support, probably buyers below 78. 77 was a strong enough reversal. It'll probably get a second leg up, and it's reversing at support, so expect buyers below 78. And then it looks like the bulls get a second leg, 77, reversal, pullback, 78, second leg to 79. Leg 1 equals leg 2, measured move, testing near resistance, so probably sellers above 79. Inside bar, and just going more sideways into the close there. In the middle of the trading range. For stop order entries today, not great on the open. I thought the first decent stop order entry was below bar 11. Selling below 11 was reasonable. Let's see through here. Some traders might sell below 19, expecting the tight channel to get a second leg down. So selling below 19, getting filled on 21, or selling 21 is okay. But if the market starts to really hesitate and bounce at support, you might think about exiting the trade early. Sell off down here. Let's see, stop order mindset. Nothing you don't want to buy here or here. But as far as selling, you're selling near the channel line, so it's not ideal. Not great for stop order trading through here. 34 is maybe okay. I thought 34 is okay for exiting shorts, but to go long is not ideal. 39 is an okay stop order sell, but I talked about the fact that it's a trading range and you might be selling near support, so that's not ideal. But the bears have the argument. Bear trend, it's near the trend line. It's a strong bar. You could sell here, maybe sell more higher. 40 was an okay buy, expecting the bull micro channel to get a second leg up. 43, reasonable stop order, sell, 3 legs up to resistance. So sellers below 43. Sellers below 44 is okay. But the downside becomes limited as we test support. So, selling 48, not as great as selling up here. 49, not ideal. Second entry long would be better. 51, there it is. You can buy above 51. You can buy the breakout 53, 54. It's buy the close here. But as you approach resistance, you need sustained momentum. The first reversal likely to fail, so you can buy and scale in lower. Let's see, stop orders here. Not ideal until here. 69 is a reasonable stop order sell. There's the wedge, 1, 2, 3. At resistance, double top with 58. Strong signal bar 69. That's a reasonable sell. And stop orders through here. Really nothing else for stop orders that is all that ideal today. For limit orders, I talked about probably sellers above bar 1, buyers below 2, sellers above 3 or 2. Even think about here, even if you sold above bar 2 or 3, this is breakout logic. You sell above these trading range bars. Say you sell above bar 2, you get filled on bar 4, and you're trapped into a losing position. How do you manage the trade? Al talks about trade management being the most important part of trading. Your entry isn't even the most important part. Having good entries is important. It's something to work toward, but management, how you actually manage the trade, is more important. If you sell above bar 2, you can scale in, sell more higher, betting that the market is testing resistance. And then look what happens. The market comes back and tests your original entry. You could sell here, scale in, and exit at break even on your first entry with a profit on your higher entry. Limit orders, buying below bar 5 is reasonable. 3 and 4 expected to get a second leg. Micro channel to 9, it's a bad stop order sell. You can buy below 9 for a scalp. Probably sellers above 10, but I'm not sure if that one triggered. Reversal follow through 11 and 12, strong pair of bear bars. Expect their first reversal to fail, so selling above 13 is okay, or selling at the breakout point, which didn't happen until later. I talked about buying below 16, 3 legs down to support. Buying below 18 was reasonable, but when 19 is your entry bar, you got to think about getting out because the tight channel might be getting a second leg down. Micro channel, expect sellers above 23, 24, probably sellers above 26, unlikely to reverse the tight channel, sellers above 27, and then sellers at the breakout point, moving average, and yesterday's low. Once again, yesterday's low was support. We sold off, bounced, tried to break below, failed, tried to break below, failed, broke below successfully and got follow through. Now support becomes resistance, so traders sell at that breakout point. 31 was a low probability stop order buy. You can sell above that bar, but the market was channeling far below the EMA at that point, probably buyers below 31. Limit order market, sellers above 33 and 30, getting filled over here. And then this was a spike in channel structure on a lower time frame, selling above 37, selling above 38. Those were also reasonable limit order trades. Buying below 38 was reasonable. Micro channel, expect the first pullback to fail and lead to a second leg. Let's see, limit orders. I thought 38 was a strong enough bar to trap traders up here, so selling at the close of 38 or selling above 39, also reasonable. Still, it's a trading range, so buy low, sell high. So when the market comes back to support, there's probably buyers below 40 or anywhere in this area. Let's see, limit orders. Micro channel, no limit orders triggered, but there probably were sellers above 45 and 46 if we triggered above those bars. Selling above 48, not ideal. It's okay. It's a limit. It's a micro channel. First reversal will probably fail, but we're closer to support at that point. I talked about the low 1, low 2, buyers below. Here, micro channel, buyers below 57. Here, probably sellers above 63, but not ideal. Sellers may come in at resistance. And the bulls were expecting a second leg up. Out selling here was okay. Even selling the close 67. Possible buy vacuum, testing resistance, double top with 58, testing an area where the market reversed. And a bull channel line, so all those reasons for selling here is reasonable. Best stop order buy 70, reversal follow through, sellers above, tight channel, sellers above 72, did not trigger. 3 legs down. 76, probably buyers below, look to the left, market's testing support. But then through here, not ideal for trading in the middle of the range. Today was a trending trading range day. You can see there was a trading range on the open, pretty clearly going sideways here, a bear breakout, and then another trading range. So this would be, I would classify this as an upper trading range, lower trading range, trending trading range day. Most of the day spent going sideways, but there was an upper range, a bear breakout, and then a lower range. All right, that's going to be it for today's end of day review. For more price action fundamentals and how to trade price action, I would suggest visiting the priceaction.com and getting the trading course. And you can learn about price action fundamentals and how to trade price action. Thanks everybody for watching today's video, and I hope everybody has a good night.